in the Infrastructure Journal webinar series, in which we'll be discussing the rising popularity of project bonds and when a project bond is the best solution for infrastructure financing. I'm Sarah Tame, News Editor at Infrastructure Journal. I'll be chairing the session this afternoon. Before I introduce you to my esteemed colleagues on the panel, a few housekeeping rules. If you're having trouble hearing, please notify us by using the chat box on the GoToMeeting panel. We like these sessions to be as interactive as possible, so please feel free to ask questions using the questions function on the GoToMeeting panel throughout the session. Now, without further ado, I'd like to introduce you to our panel of experts. With me today, I have Alistair Higgins, Head of Structured Bonds at ING Bank and a key proponent of the bank's Pebble product. Cormac Murphy, Head of Division for Structured Finance and Trans-European Networks at the EIB. Cormac is responsible for the EIB EU 2020 Project Bond Initiative. Dominic Nathan, Managing Director of European Infrastructure Finance at Monoline Insurer Assured Guarantee. And Prashant Satyadeva, Partner in Structured Finance Team at Berwin Leighton Paisner. And finally, Andrew Davison, Senior Vice President in the Global Project Finance Practice at Moody's Investor Service. Welcome to you all. After many years of a traditional project finance model centered on bank financing, it can be said that we are moving into a new era of infrastructure financing, with a number of new players joining the game. With new financiers come new financing structures. The rise of the project bond is testament to that. Project bonds are becoming an increasingly popular form of financing for infrastructure, with over 10 deals closed using project bond financing in Europe this year. This summer also witnessed the close of the first deal under the EIB's Project Bond Initiative, something Cormac can expand on later. So why is the project bond back in vogue, and is it here to stay? Alistair, perhaps you can start us off on this point. Why are project bonds so popular?
I guess it's really driven by two things. One, a change in the appetite for the banking market, perhaps coupled with a resurgence in the pipeline in certain jurisdictions, and at the same time a search for yield from institutional and other investors in the asset class. And I think it's that crossover point that we're now sort of getting to the critical mass for the institutional investor market. That means that they are finally now crossing into the project and the infrastructure space. I think it's always going to be about yield for that institutional investor class, and it will come and go as time evolves as to who invests in what shape and form, and it's that the market has to deliver the right format for the right project.
And Cormac, from the EIB point of view, can you give us kind of a brief overview of the Project Bond Initiative and the knock-on impact on the rest of the market that the initiative has had?
Yes, thank you, Sarah. And I would echo what Alistair just said. The project bond market is, I mean, we've seen first movements this year. Alistair mentioned 10 different bonds. One of those was a first public bond issue, which was the Castro project, which I'll touch on a little later. In fact, the variables which are driving the market in terms of long-term financing availability from the banking sector, and that has been curtailed because of regulatory changes, also because of a deleveraging process taking place, and the stepping up by institutional investors. This is also where the EIB EU initiative is playing a role. In terms of the initiative, it is a credit enhancement initiative. It is designed to achieve a credit rating improvement of transactions from a level which is typically associated with PPP, PFI transactions, in other words, in the BBB range, to one in the single A range, which is arguably a sweet spot, or potentially a sweet spot for investors in terms of regulatory and capital treatment. EIB also brings its expertise, its long-standing support for the sector, the infrastructure sector, which is the predominant part of EIB lending. And this initiative in the project bond area to some extent complements the bank's lending activities across the board. In terms of what effect it has had on the market, I believe it's been helpful from the point of view, first of all, at a policymaker, at a public policy level, in terms of highlighting the potential of the institutional market. we believe it's also been quite helpful in terms of the institutional investors themselves, in terms of giving profile to the opportunities of the market, but also the public policy interest in institutional investors stepping into that market. There's also, as you may have seen, there was a long-term paper by the European Commission this year on how to, well, issues faced in increasing long-term investment, and particularly from the institutional sector. In terms of the popularity of project bonds, and this goes to Alistair's point, I mean, clearly there is a trade-off or a question here in terms of looking at ratings, looking at yields, comparing to other asset classes. We believe that infrastructure, and particularly the PPP, PFI area, is one that has a robust quality for institutional investors. And when institutional investors are looking at long-term assets and matching those assets to their liabilities, we believe infrastructure has a role to play. And that's been reflected very much on the ground in terms of increased interest by institutional investors, but also in terms of asset allocation decisions which are being made or have been made over the last year or two.
Thanks, Cormac. And outside of the EIB initiative, there have been a number of other successful project bond deals in Europe. Dominic, you've worked on a few of these. Perhaps you can talk us through some of the project bond deals you've done this year.
Yes, sure. Happy to. I mean, certainly we were delighted to get 2 deals done and closed in July of this year. And I think, as people know, it's been quite a long time coming for a wrapped product to come back to the market, and it has been a difficult environment given what happened to the monoline industry. So really the first task in getting these deals done, which we've been working on really for the last 2 or 3 years, is getting investors, or a decent core of investors, on side with assured guarantees credit risk, given what happened to other monolines, and convincing them of the benefits of the wrap, which I think for the investors primarily revolve around really what Cormac was talking about, but a different way of getting from BBB minus, BBB flat, into the A or AA category in terms of credit enhancement. It also helps investors mitigate the construction risk they're taking on the deals that we were looking at, and also, again, capital was mentioned. Capital benefits for insurance companies under Solvency II is a big benefit of the ratings uplift. So once we got a core of investors on board, which we did, we were then able to go to the sponsors and to the public sector, particularly Infrastructure UK, to talk about the deliverability of our product and get everyone on side, demonstrate the value for money, to get mandated on a deal and to take that forward. And that culminated in these 2 deals, one of which was a housing PFI transaction up in Leeds for the refurbishment and new build of social housing as a wrap bond, underlying ratings of BBB minus, Baa3, enhanced to our rating of AA minus, A2, which is what the bondholders are buying, and was successfully distributed among institutional investors and reasonably widely distributed for the size of the bond, and indeed oversubscribed. And then we followed that on quite closely with a student university accommodation transaction for Edinburgh University, which was a little bit smaller but had 2 tranches of debt, an index-linked tranche of debt and a fixed-rate tranche of debt. And again, you know, reasonably widely distributed to the market, oversubscribed, and I think everyone was very pleased to see that transaction close at the price that it did. And then we've got 2 more transactions coming, which are scheduled to close next month, both PFI transactions. So in a short period of time, we will have 4 transactions done under the wrap model. So you know, that sort of has proven our deliverability, enhanced the credibility, and you know, hopefully plenty more to come.
Thanks, Dominic. So bonds are back, but when is the bond the best solution for infrastructure financing? You know, banks are having to scale back their lending capabilities as a result of Basel III, and the terms they can lend on is less favourable than previously. However, recent IJ data has shown that lending is not as short-term as some might presume. So when sponsors are looking to explore new avenues of financing, what are the benefits for the borrower from bond to bank? Alistair, you're a banker. What's your view on this?
Sounds like you're accusing me of something there. I guess maybe a point to make first before jumping in and answering that question. I have a rather unusual role within ING versus some of the others here today, in that I can be reasonably neutral as to the way that we go out and finance our assets. That is that the bank, of course, can lend money in certain circumstances. We have our own Pebble product, which has been established as an open format for the market as a whole. But also, I'd be perfectly happy to facilitate and work with other providers, such as Dominic, such as Cormac, to help our clients to tap the liquidity they need. So really, to my mind, it's about getting the best for the client. And for us as a bank to facilitate that, then it's about working out value for money, deliverability. So the first two parts you need to demonstrate to any client before suggesting or proposing or deciding even that any given solution is the way forward, is to make sure that given the procurement process they may be going through, the competitive process they might be faced by, that the solution is deliverable and that it is competitive. And on occasion, sometimes you can look at a project, you can look at an asset, and hand on heart not say that the project bond is the way forward. You can identify that actually maybe a club bank debt deal is the preferred solution, the easier, the quicker solution. So really, what drives that? I think clearly one would be tenor, complexity. Today we're at the beginning of what's been a nascent market. It's not taken off yet. We see the green shoots, as it were. So I wouldn't want to go in there and take a Skynet 5 or a Metronet transaction right now out into the project bond space. But clearly, the projects that Dominic's done, that Cormac and that we with Zansad have done, those are the starting points of bringing that market to fruition. And tenor is clearly a driver for that, and pricing tension, pricing competitiveness. I think all of us would be proud that these are coming in more aggressively priced than some of the pure bank debt solutions.
Andrew, Bashant, do you have anything to add on that point?
Yeah, no. Bonds did make their way into social housing, not just on Leeds, but south of Pendleton as well. For those of you who aren't aware of that scheme, it's a social housing HRA scheme, which was awarded to the Together Housing Group back in 2011. There's no rental collection or void risk in relation to the underlying scheme. It's purely about refurbishment and maintenance of 1,270 housing flats in the Manchester area with a 3 to 4 construction year profile. The building contractor is Keepmoat. They had a sort of tricky 2012 where they went through a restructuring, and originally it was a syndicate club of banks who were mandated for that financing back in 2011-12, but that solution was not preferred from a value for money perspective, and ultimately the sponsors and the authority were very much looking for an alternative financing solution, i.e. project bonds, and it was a Hayden's Wall capital type funding mandate where you have a dual tranche structure which isn't wrapped, which was ultimately chosen.
Thanks, Prashant. And Andrew, did you want to add anything on that point? So, Alistair, I wanted to come back to your point there on tenor and pricing. When sponsors are looking at the bond or the bank solution, can a project bond provide a competitive alternative in terms of tenor and pricing?
I think there's two obvious aspects of the commercial bank market that are anti-long tenor, if you like. Putting to one side the actual tail itself on the concession, the two I would identify as prevalent right now and for the last 5 years are substantial margin step-ups and punitive cash sweeps. And both of those really point to the banks wanting shorter duration on their book. So even if you get tenor, quite often they are evident. The institutional market have no such qualms. Clearly they want to match their liabilities. They're looking for duration. What we don't want to see happen, though, is a deterioration in the credit as a result of that. So we look to reasonable tenors versus the concession. And then, of course, if the concession is longer, you may well find that institutional money, depending on its liability match, may be able to go longer. And what does that mean? It means if I'm a pension fund, if I'm a life insurance company, I have liabilities that run out for 40 years, well then, yes, I may well want to run with a tenor of a debt to that extreme. Whereas a bank, I don't think, would be too keen in that situation.
Dominic,
just to sort of add a piece of evidence to that, because I completely agree with that. The Edinburgh University transaction that we did was 35 years in tenor, and it's hard to get that sort of tenor from the bank market, even those that are lending long term. So that proved value for the sponsors and the university there, and also to Alistair's point. But we were allowed to do that because there was effectively a 50-year concession, if you want to call it that. It's not quite the same, but you've got a 15-year tail. So from a credit perspective, that works as well. So as long as the credit parameters allow for it, then the longer the better in a way for the institution.
Yeah. And the social infrastructure sectors, particularly the accommodation and the housing type deals, they seem to be very popular with the project bond option. Prashant and Dominic, you both worked on those sorts of deals. I mean, why is it that sector particularly has been popular with a project bond option?
I think my view of that is it's more sort of what the opportunities have come up rather than anything too fundamental. I think these particular housing deals that we were talking about are kind of legacy PFI transactions. They were being financed in the bank market, as was mentioned, and that no longer proved value for money. So the bond market in various forms stepped in to take over the financing of that. I think had that been another area, there may have been more competition. Perhaps not so many banks are involved in social housing, but it's still a competitive environment. So I think it's more what was opportune versus the pipeline now, which isn't massive. It's really a combination of those two facts, because I think you'll see these products in other areas of PFR and PF2.
Yeah, I'd completely agree with that. And another point I'd add is when people talk about bank versus bond, it's almost like there is no information asymmetry and it's a level playing field. And I'd certainly question that if we were here, say, 12 months ago, because I think there's a lot of sponsors around who obviously were questioning execution risk for project bonds. Ultimately, this is in an infrastructure procurement scenario. You want certainty of execution, you want certainty of pricing, and with a bank club deal, you've got banks around you on the table, you know what their term sheets are. With bond investors, there might have been a perception of certain risks, which hopefully a lot of these deals are now proving is a much more certain execution.
I would add, though, that risk does exist. I mean, because we are seeing there's a growing number of direct investors, and if I could be so blunt as to say, they are yield investors, and banks are traditionally relationship investors. It doesn't mean the banks don't like making money, but at the end of the day, there is pressure that a relationship at the corporate level brings to bear in the bid process that doesn't see investors pull out at short notice, whereas in the direct institutional market, we have seen examples where that's taken place. So what I think is important is to get liquidity, to demonstrate that if it isn't investor X, it's going to be investor Y. And then that nervousness falls away. And we all talk about there being plenty of liquidity out there, but quite a few projects still have a handful of investors, and that's dictating the market at the moment. I think that needs to build up before we have that real comfort.
Sure. Just in relation to the specific asset class, social accommodation and housing, the credit story is relatively straightforward, and I think that is helpful to your point, Alistair, that the liquidity is often an issue for specific asset classes. Secondly, the question of tenor, certainly the way in which banks often assess tenor is to view tenor itself as being a risk multiplier. Yet for long-term, fully contracted projects, our view from Moody's perspective is that tenor isn't necessarily an issue, and in particular in some of our research that we've published on default and recovery attributes, we associate with the infrastructure asset class and the project finance asset class underlying resilience in terms of low transition risk for the asset class, and this is a key characteristic. So in that sense, tenor, in our view, isn't necessarily a risk issue for these particular credits.
Great, thanks, Andrew. And Cormac, did you have anything to add on that point?
No, I fully agree. Also, with what Andrew just finished with. I mean, I think one has to look at the institutional investor space. I mean, it is a long-term investment. It is, to a large extent, going to be a buy and hold investment. It's a relatively illiquid asset. To that extent, clearly, investors are looking at the underlying nature of the deals and the suitability for their investment portfolios, and their clearly infrastructure, if you look at it as a group of assets, clearly has particular characteristics compared to other asset classes. Also, in terms of diversification or correlation with other asset classes, it is quite distinct as well. And I do believe that investors are looking at it from that point of view.
Great. And we just had a question from one of the listeners actually, which follow on quite nicely to our next point of whether institutional investors are willing to take construction risk. So, you know, recent project bond deals have been mixed in the sense that we've seen both refinancing and operational projects, as well as a number of deals financing sort of construction phase social infrastructure projects. You know, Andrew, you wanted to have a few words on greenfield and brownfield risk. I mean, maybe you can start us off there.
Sure. I think in terms of just framing some observations around construction risk, I'd like to raise 4 points. Firstly, for the project finance asset class, there is no doubt that high level of monitoring oversight required during the construction phase, and that might be illustrated by elevated level of oversight required by a controlling creditor to ensure that there is satisfactory progress being made, that conditions precedent to each drawdown are being met or released from controlled accounts. There may be waivers and amendments, all of which requires some degree of process and timeliness around controlling credit decision-making, and to the extent those waivers and amendments may be material, a need to involve a number of the underlying investors as well. So high level of monitoring is required during construction. Secondly, what does the data show? Well, the research that we've published shows that there is elevated default risk and low recoveries for construction phase defaults. And in that sense, whilst the number of construction phase defaults is relatively modest, it is an elevated period of risk for typically for projects during their life cycle. And one of the key issues, however, is the transition risk from completion of construction through to steady-state operations that might arise, for example, from ramp-up of traffic risk, or perhaps mobilization of resources moving from a newly constructed asset to an SPV project co providing steady-state operations. So there is incremental risk, no doubt, associated with the construction phase activity. Thirdly, however, there are a number of structural mitigants to construction risk, and this is of particular interest to sponsors who are looking to structure projects efficiently to tap into different liquidity at different parts of the risk-return spectrum in senior debt space. But certainly there are a number of mitigants which allow projects to achieve a more benign risk profile and substantially mitigate construction phase risk that I identified. So, for example, the project bond credit enhancement facility would be available to mitigate cost overrun risk and provide additional liquidity to the extent that liquidity was an appropriate remedy to allow a project to reach successful conclusion. Then certainly that facility under the EIB project bond credit enhancement facility would provide a much more resilient project. Likewise, we're aware of a number of banks who proposed letter of credit facilities to wrap construction risk, or indeed government-backed risks. So there are a number of structural mitigants. Lastly, my point is that risk isn't necessarily a bad thing. There are a diversity of institutional investors out there, each of whom has a different risk-return appetite, and provided risk is appropriately remunerated, then it could be an appropriate diversification within a portfolio, or it could be a yield enhancer for a risk portfolio. So the key issue then is whether risk is appropriately calibrated and remunerated. So risk is not necessarily a bad thing.
Great, thanks, Andrew. And did anyone else have any points to add there, Alistair?
I think I was just going to come back. I mean, I think the answer to your question is yes. Yeah. At the end of the day, though, do institutions want to have construction risk? If the answer was, can I have 300 basis points, no construction risk, single A, they'll take that over the 200 basis points with construction risk. And every brownfield was once upon a time a greenfield. It sounds like a fairy tale story or something. But right now, we've burnt through the recycling of a lot of banks selling assets. The brownfields have been recycled to death, and people are having to now reevaluate where else they get these assets. And so greenfield is the obvious place, and we're seeing a lot of buyers of these assets now migrate down to the greenfield. It may not have been what they perfectly would have liked to have had, but they're perfectly happy with it, as long as, and as Andrew says, that the yield is there to reward them for it. But simultaneously, we're going through a yield compression right now. Pricing is just getting tighter across the board because of the scarcity of assets.
I think the question almost for the institutional investor appetite is wider. I mean, do they like construction risk? I agree that's changing, but do they like construction risk at a BBB- level or Baa3 level, which is more traditionally where it's been, without kind of super enhancement of the construction? And I think that is still a pretty thin market for investors on the cusp of investment grade because of the risk of something going wrong in construction and falling below investment grade. So I think we are going to see more institutional investors taking construction risk, and we've got the M8 transaction coming up, which will be interesting, where you've got a higher rating to support that. But as I say, I still think you need some form of enhancement, and whether that's assured guarantee or whether it's the project bond initiative or Pebble or whatever enhancement it is, but you need something to take it away from that traditional Baa3 area that construction risk has traditionally formed the rating.
Right. Yeah, I agree with that, Dominic, and it's quite an interesting point you made about rating attachment during the construction period, because this year I also saw the Hertfordshire University accommodation deal, New Living, which attracted an A- rating, notwithstanding the construction profile. I guess there were two sort of notable features as part of that package. One was a lower debt leverage at about 75%, and the second was there was a 12.5% on-demand performance bond given as well. But it was a bond format and obviously placed with a very large institutional investor.
Right, thanks.
But just one other point to make there is that the rating, to my mind at least, is partly a liquidity driver. There is appetite for BBB. It's not as much as there would be for single A. If I look at the cost effectiveness, well, a BBB doesn't need the same level of bonding as a single A, obviously. And so for whatever you save in terms of that, you will probably have to pay it away again in the higher coupon or high yield. We obviously closed one project recently without a rating. It was implicitly an investment grade opportunity with the Pebble enhancement. There are also investors out there in this same space, some of the big insurers who are happy to invest directly at investment grade. That doesn't mean that that's where the perfect spot is, and as Dominic said, you do tend to get the greater liquidity up at those higher rated levels, and so being able to have a view on all of those field transactions is important.
Yeah, which brings me quite nicely to my next point. Actually, an important factor, for many investors is the rating of the project bond of the assets, and coupled with that, any other financial guarantees in the deal structure. But a question we've had actually from the audience is: are ratings necessary for a bond issue? Alistair, do you want to carry on with that point?
Yeah, sure. I mean, I guess the natural follow-up to that is no, they're not, because we've just done one where it wasn't. That doesn't mean they're not very relevant and appropriate in certain circumstances. But if I could just, and if you will indulge me for a moment on it, tear apart your business model for a second. Putting the rating to one side, the reason it can be a success to be a monoline is that you are a trusted participant in the market who understands the asset class and will lose a lot if the project goes wrong. And that's essentially also what the EIB is doing with the PBTE. It's what Pebble does with its credit enhancement. It's what Hadrian's Wall is doing as well. It's all about having expertise in the market to gauge and assess those projects, and a credible assessor as well. So it's not the rating per se that does it. It's the fact that someone then could take you on trust. They know that because you're AA, single A, that yes, you are a credible market participant, and they know that you're going to suffer a world of pain, as all the previous monolines did, when things go wrong. And that's really a very common business model we're seeing across the spectrum. Sorry, Andrew.
Yeah, maybe I can try and frame a response to the question that came in on are ratings necessary. I think there's a number of points here. Firstly, any investor will need to make an assessment for internal regulatory capital purposes, and the assessment is necessary, but isn't necessarily undertaken or discharged through an external rating. There may be an internal credit purpose or internal credit view formed, which is appropriate for regulatory capital purposes. But certainly an external rating can address that need. However, even if the credit assessment is undertaken from an internal perspective, there is, I think, in many respects, a value to an external objective opinion of credit risk, such as that provided by a rating agency, not necessarily just Moody's, but any regulated rating agency would perform that function. And the feedback we get is that external objective opinion is valued both internally within investors and also externally in the market. In terms of another point Alistair made is that, however, one of the values of having a rating is that it certainly provides liquidity to the investment. Providing there is objective research in the public domain, it provides confidence about the issues which have been assessed and evaluated by an objective third party. And therefore, in that sense, I think there is value to the rating in providing liquidity in otherwise illiquid or opaque market. It may also achieve a different universe of investors. There are some investors out there who require an external rating, so in that sense, it may expand the universe of investors able to access or come into a particular asset. But I think in summary, there are significant diversity of investors out there, some of whom require ratings, some of whom are quite happy to proceed on an internal basis. So I think, just to summarize, I'd probably concur with where Alistair started, which is the short answer: are ratings necessary? No. But are they helpful? I think the answer is yes.
Yeah.
Dominic.
Just a quick final comment. I mean, I see the requirement for ratings from a regulatory perspective only going one way, and that is, to having more ratings for those that don't over time, particularly when we see Solvency II come in, which keeps getting pushed back. So I mean, I'm talking several years, but I really see that regulatory pressure only going that way.
Great. So I'd like us to move on and talk a little bit about wrapped versus unwrapped bonds, and obviously around the table we've got parties experienced in both of those types of deals. Prashant, maybe you can talk us a little bit through the Pendleton deal, which was unwrapped.
Yeah, sure. Just looking at wrapped versus unwrapped and Pendleton in particular, I guess a couple of points we just made in terms of a function provided by them online is not just enhancing the bond to a specific rating attachment point, but also performing a controlling creditor function where its interests are aligned with the bondholders. Where you have an unwrapped bond, there are going to be issues surrounding, obviously, the controlling creditor function, in that bonds are typically held in clearing systems. It might be a disparate bunch of bondholders, and the way those sort of voting procedures work doesn't particularly suit projects with construction risks or sponsors who might need to go back to their lending syndicate for waivers and consents. In that context, Salford Pendleton, I guess, was important for two reasons. One was it was the first bond to implement a senior substructure and be unwrapped without external credit enhancement. That was from the perspective of getting higher inferred ratings for the senior bond. And secondly, it came up with a concept which is different to a controlling creditor function. When people talk about controlling creditor, it's usually associated with a particular party having control and then switching control based on certain trigger events. I think it would be a mistake to talk about a controlling creditor on Salford Pendleton, because there are a variety of rights which are still exercisable by bondholders, which they want to be vested with bondholders. So what we did was we came up with a categorization of rights falling into one of four levels, the higher levels of which would either require entrenchment and unanimity amongst bondholders, i.e. veto rights, and the lower levels, which allows the managing agent, FHW, the former HWC team, to actually administer the loan and act as an interface to the borrower to deal with waivers and consents without necessarily going to bondholders.
If I can just chip in here, to some extent the terminology wrapped or unwrapped is looking in the rearview mirror of where the industry has been or was. Simplistically, the concept of wrapped is one of credit substitution of the underlying obligor with that of the provider of financial guarantee. What we are looking at in many cases going forward is the concept of credit enhancement as opposed to credit substitution. And that's very different. And you're starting then with the credit quality underlying obligor, and then enhancing that rating up the or to improve its credit characteristics, but not necessarily to the point where the credit quality underlying is substituted with the credit quality of the entity providing the relevant support.
Great. Anything else to add on that point?
Yeah, I just sorry. So I just a couple of points. Unwrapped versus unwrapped. I mean, I think the whole controlling creditor issue from the investor's point of view is incredibly important, and I think, not surprisingly, I might argue, I think having a wrap bond is really the only way to have true alignment between the bondholder and the controlling creditor. I think if you've got purely unwrapped, then you've got someone just taking a fee to make those decisions for you. I think that's quite difficult over the long term. And whilst I understand the mezzanine structure, I think there are definite scenarios you can come up with where the mezz is going to have a different incentive than the senior, and I think that might be interesting if we ever get to that stage. But also, I think from the borrower's perspective, it's all about cost. I mean, that is the main thing, and it's sort of what Alistair was saying earlier, that you can't just compare these kind of headline debt figures now. For our product, for example, you've got the ability to have a high leverage, let's say 90-10, reasonably low construction support package, reduce the cost, but then you've got to pay a short guarantee to get to your higher level, and then you've got to figure out that economics versus the enhanced deal, for example, we talked about putting much more equity in, more construction support. What's the cost of that versus the coupon? So they're quite complicated ways to measure these, but cost is the key thing for the borrower.
I'll just add to that. I think you're right. The cost is the key thing, but obviously I would disagree with you wholeheartedly on the online one. I mean, I think look, there's this alternate model which Pebble uses, and that Hadrian's Wall did to a point, and obviously the new Salford Pendleton transaction. There is one thing that's trying to achieve that actually also Assured does, and I presume the EIB PBC does as well. It simplifies for the investor the level of waivers, the level of consents they need to be involved in, because these are not well-resourced teams from the institutional side. They do not want to be involved in the nitty-gritty, benign, non-critical issues, and it's actually quite, when I say simple, I'm maybe not doing you a disservice here, but it is possible to distinguish between material and non-material waivers and consent processes, and at the same time give the borrower the confidence and comfort that they have a known counterparty, that single point, that interested party to help them align the interests of the lender group. So I think that is a powerful model that can work, but it's equally powerful for an assured guarantee type approach.
Yeah, I completely agree with that, Alistair. And then looking at it from a landscape perspective and roadmap perspective, if we look at what the Department for Education is constructing with the aggregator model for the UK Priority Schools programme, the base case, the sort of examples given during the bidder day, is very much an unwrapped bond and a senior mezz structure, with obviously bidders invited to submit their financing plans. But I think it is quite significant that we now have people like Treasury being involved in crafting or allowing people to provide alternative solutions for quite critical UK infrastructure projects.
Coming back to Dominic's point about value for money, if the proposition is that for many steady-state projects during the operations phase, the credit quality is possibly in the single A territory, has the potential to achieve that, then the key issue from a commercial perspective, maybe a sponsor's view, is what is the minimum credible credit enhancement required to achieve a rating at a particular price point and particular risk point from an investor's perspective. So potentially, if that looks like an efficient financing at single A out of the box, what is the minimum credible enhancement to mitigate construction risk and transition risk to steady-state operations, which achieves the most efficient financing solution? And in that sense, a credit enhancement proposition may be rather more interesting for commercial parties to consider than a complete wrap.
Great, thanks. And I think if we, Cormac, if we move on maybe to talk about the EIB's initiative. Can you give us kind of a brief overview of the project bond and how that's helping to provide a guarantee to projects?
Yeah, okay, no, that's very good, and perhaps I'll touch on a couple of points that were just mentioned in terms of the role of credit enhancement. No, the Project Bond Initiative is something which was launched at the end of 2012. It's been in full operation through to 2013. There was the first project bond issue which took place in the summertime for the Castor gas storage project in Spain. That was a large bond issue, 1.4 billion. The EIB was also an investor in the senior bonds, but in total there were 29 investors, including EIB, representing a broad spectrum of investors, and meaning insurance companies, pension funds, asset managers across Europe. What I think that showed, and some of the points already mentioned, for example, controlling creditor issues, one of the aspects that came through in that transaction was the willingness and the capacity of bond investors through a public bond issue to work through a structure which is a very clearly defined decision-making process and structure. That means decisions are defined based on materiality, decisions are defined based on the bond voting, the quorum, the majority, etc., and there's also a role of a monitoring advisor to assure that there is full information flow at all points to investors. And I think that was an important aspect of that transaction that has potential in future transactions. As regards the EIB initiative, that was the first project bond. We're expecting to come with some additional project bonds in the coming months, in the remainder of 2013, going into early 2014. They will be in different countries, also different sectors. In terms of the market reaction to the project bond initiative, I think it's been important that there is a perception that there is a public policy goal and a public policy instrument to go with that. And that is also from an EU EIB point of view, that while we are in the pilot phase, and the pilot phase is intended to cover 5 to 7 projects up to the end of 2014, there's already funding for 2014 and 2015 under the future EU budget for a continuation of the instrument. In terms of where we are now and some of the issues which have been discussed, for example, greenfield, we are hoping to come with a first project bond which will have greenfield risk. In terms of ratings and what is possible to achieve and where investors are willing to step in, the Castor project showed the willingness of investors to invest in the BBB range. That was for a project which was for a regulated asset, a strong asset, and whereas with the benefit of credit enhancement, the rating was above the sovereign level. And obviously investors looked at the quality of the asset, they looked at the quality of the rating, or the rating improvement through credit enhancement, and of course what yield was offered for that asset, and saw that as an interesting proposition. In terms of the initiative and where we see things moving in terms of institutional investment, we see that this, i.e. the market, is going to continue to grow and develop, to widen and deepen, both in terms of the number of transactions and the number of investors. And the EIB Project Bond Initiative, together with the Commission funding, we expect to be an important part of that.
Thanks, Cormac. And I guess open it up to the rest of the panel. What are your views on the initiative, and is it necessary for the market, and has it been something that's helped to drive the popularity of project bonds? Anybody like to touch on that?
I think it's noteworthy for the ambition of what's being trying to be achieved. I think in some ways there's always that love-hate relationship, and not with Cormac obviously, but with the EIB historically, because the EIB under the structured finance facilities is sometimes there when it's not necessarily needed. And there's actually a project in the pipeline right now where the EIB will be there for 50%, another multilateral will be there for another 20%, and when you're done with the commercial placement, you're down to a very, very small sliver. That basically means the market just won't follow that transaction. And it does, if you look at the innovation we've seen around this table, and in the market as a whole, if you look at the assured guarantee models, the Hadrian's Wall models, the Pebble models, none of them have ever closed alongside the EIB. And they're on transactions where maybe it was incompatible with the structured finance facilities. And so then that's the one side of the EIB. Then you've got the project bond initiative, which is very impressive and very, I have high regard for it, but it is a proprietary one-stop solution. It can't coexist with, well, it's not easily with an assured guarantee product or a Pebble product or a vanilla direct project bond. So I think there's great points to take away from it. There's an incredible number of transactions where it does benefit, but it would be good that we see that where the market doesn't need it, that we can still call this public-private partnership rather than public-public partnership.
Sure. If I can just make some observations, I think a number of the market issues which the EIB's project bond initiative is intending to address are the so-called infrastructure funding gap, which in the medium to long term is a fundamental concern at senior policymaker level, at institutional level across European Union, and internationally we see the same tensions or debates being had by decision makers at an international level. But the key issue is that banks are unlikely to be the natural holders of long-term debt going forward, and what the EIB and indeed other parties are trying to do is to develop liquidity in other long-term funding markets for the medium to long-term benefit of society, which, you know, as a taxpayer, I have some interest in that particular objective. However, at the moment, I think that the issues that Alistair is commenting on is that, you know, there is a relatively thin pipeline this year, and 2014 may also be thin, and therefore at some point there will be some kind of matching and a flip potentially between the number of investment requirements that are necessary going to be seeking funding and the ability of the existing group of funders, predominantly banks, but increasingly a broader spectrum of institutional investors and other parties to meet those funding objectives. So in that sense, the strategic objectives of which the Project Bond Credit Enhancement Facility from the EIB, these are important to demonstrate the concept and to grow support for the asset class such that in the medium to long term this becomes a viable funding option for sponsors to achieve those funding of public-private partnerships that Alistair had mentioned.
I mean, it's a good point also to build on, in that if you take the example of the Green Investment Bank, they take a very different approach to this. They're trying to create models that can be then replicated in the private sector in due course and can be used to leverage existing and future appetite into that space, which I think is sort of a laudable approach in that respect. Yeah,
thanks. And I think a point I'd like to touch on that you raised, Andrew, sort of, you know, the way that these sort of solutions and models can offer a blended solution to borrowers. And, you know, moving on from that, is the project bond as a whole just one sort of minority solution to financing projects, and will it be seen as in combination with other, you know, traditional lending models? Anyone like to take that point on?
I guess, sorry, go on.
I think what is clear is that for many, many years, the banks have been willing and able to support the funding of long-term or provision of long-term debt to support infrastructure funding. Banks have got significant expertise and experience in terms of structuring transactions. I think the point is, the fundamental point going forward is that banks will unlikely be able or willing to provide long-term debt in the same quantum that they have done previously, and therefore banks, I think, still have those key skills to structure and create investment opportunities, to work with clients, to manage construction risk. And there are other parties coming into the market with those same skill sets, including the likes of assured guarantee, etc. But I think, to answer your question, as the market evolves, I think necessarily there will be a range of different funding solutions. and it will be incumbent upon financial advisors working with sponsors really to optimize the different potential funding sources for individual transactions for the benefit of sponsors and procurers.
Does anyone have anything to add on that point? So I'd like to move on then to talk about market capacity, and it's evident that project bonds are becoming increasingly popular. When can a project bond provide the best solution? But one final question is, with the exception of the EIB's project bond issue for the Castor Storage project, all the project bond deals that have closed to date have been fairly small size debt packages. We're looking at under $500 million. Does the bond market have the capacity to deal with big projects?
Yeah, I mean, I think it definitely does. I mean, you're right. The sort of projects that we've seen, a lot of them, including ours, are definitely at the smaller end of the scale, and you sort of think, well, is that the capacity? I just don't think it is. I think these things build upon themselves anyway. I mean, we talked about fundamentals at the beginning of this call about investors, looking for the asset class, and we've had many more inquiries since launching our two bonds as investors that didn't come into that want to be in the space. I think one of the key things is from the area that we look at is getting into the index, the bond index for investors is important, which is set at the £250 million mark. So you've got a little bit of a no man's land before then, but I think the small deals can easily get done as we've shown, and then if you get over the 250, you bring in significant new investors. Plus, we are also seeing several investors now with very big tickets. I mean, they've got a lot of money that they want to invest, and they are capable of writing tickets 100, 200, 300 million pounds or euros. And so I think that will enable people to see these deals can be done. And one unwrapped deal that we saw that done a little while ago now was the UPP bond issue, which I think was nearly 400 million pounds. So yeah, definitely capacity.
Yeah.
I mean, it's fair to say as well that the projects haven't actually needed much more. Mm-hmm. You can't stick 400 million debt into a project that only needs 200. So I think it will prove itself as the market sort of develops and grows. But as Dominic says, the liquidity is certainly there, and I think all the project bonds that got away recently, everyone's saying, and I believe it's true, that they're oversubscribed, that there's a lot of appetite for them.
And so, moving quite nicely onto a question that we've had from the audience. In contrast between private and publicly placed bonds, and are we seeing kind of private placements becoming more popular, and is that something that will see one investor taking a large ticket on a bond in comparison to the publicly listed bonds?
I think that's a reasonably unique set of circumstances right now, actually, that we have a reasonably thin or pretty thin pipeline, certainly in the UK, and a lot of the deals are quite small, so it's sort of enough bite size for these institutional private placement players. So I think whilst the market's like that, which I think it is in the short term, you will see that. However, I don't see that as a sort of trend, if you like. I think as the pipeline does get bigger over the medium term, they won't be so keen to do these private placements. You'll see more public listed issues providing more liquidity, and I would think over time being cheaper than those private placements.
I think there is one variant on that theme in the Dutch market, for example, which I may be uniquely placed to talk about. But in the Dutch market, the Treasury have gone out on record to say they need 100% committed financing at bid stage, and that lends itself to a private placement model rather than public placement. So I think there's upside and downside in that. Yes, they know they have the financing, and could they have got a better price through public placement? Quite possibly. So maybe we'll see that sort of reevaluate in time. But in the intervening period, and up until now, they've had a great success story. They get their commitments in, 8 weeks later it's closed, 10 weeks later it's closed. And you can't necessarily do that with a public placement and with ratings processes and so on, post the sort of documentation stage.
Great. So we've had quite a few questions from the audience. So I'll just run through a couple of those before we get to the end of the session. So one question that we've had is, will project bonds still be here if yields pick up, and will they continue to just be a minority player in infrastructure financing?
So if yields pick up, definitely. I mean, sure, yields go down would be more.
Yes.
Yeah, yields go down. Yeah. It depends on the alternatives available. I mean, no one obviously goes and buys Gucci because it's cheap. They buy it because it's expensive, and we're here all trying to finance these assets because we're the cheapest. We have to win the financing, and yes, that leads to price competition. We're seeing a slump in the overall yield achievable on these assets. But so long as that's better than the sovereign gilt plus the risk premium that they believe they are due, then I'm sure the investors will stay tuned to that space.
But I think the pricing issue is one of comparing the alternative funding solutions over the whole life of the asset, and tenor is particularly important as a driver of minimizing whole life procurement costs. And in that sense, the ability of bond investors to go long term is particularly important compared to where the banks in general are today.
And another question that's a little bit more specific, what happens to the liquidity premium when financing through a bond structure on a deal?
I'm not sure I understand the question. What happens to liquidity premium?
Yeah, when financing in comparison to a bank financed model.
I mean, I guess we're talking about whether whether pricing gets tighter.
Mm-hmm.
I mean, it depends if it's a public or private.
Yeah.
If we have to take the recent Zanstat project, there was a firm committed price at BAFO. So there is no change. The price will be the price. If you go and look down a public placement, you may well find that the pricing varies by the number of investors. If there's excess liquidity, that may drive price intention down. I guess maybe Dominic, you want to talk on that point?
I'm not sure I've got much more to add there. I mean, definitely these smaller deals are more illiquid, and you probably are paying something more for that, but as long as it's cheaper than the competing products, then that's okay. And I do think over time, as you're getting more supply into the market, then there will be more general liquidity regardless of the size of the bonds, and you'll see very small, if any, liquidity premium, I think.
And the extra liquidity in the market should drive pricing tension, but many of the investors, they still have benchmarks that act as a floor. So you may have a 5 times, I mean you won't, but you may have, let's say theoretically, a 5 times oversubscribed bond, but you still will stop at a certain pricing point where you're not going to see the bids come in lower.
Prashant, did you?
Yeah, I guess it's not just pricing tension, but I guess a lot of people have this concept of an illiquidity premium, which is charged by bond investors when looking at their portfolio versus, I don't know, rated corporate bonds, for example. The only point I'd make in that regard is obviously a lot of these assets are suited for insurance companies with pension funds who need that annuity profile, and a lot of these investors are buy-to-hold investors. So whilst you might theoretically have an illiquidity premium, it's obviously well suited for their portfolio.
Great, and we've probably got time for one more question, and something that's come up from quite a few listeners is the prospect of financing energy projects through the project bonds model, particularly looking at power and renewables. And would anyone like to comment on that? Cormac, I wonder if this is one for you.
Well, just as a point of clarification on the EIB EU Project Bond Initiative, energy is part of the initiative, but the focus is on the networks, the transmission networks, rather than the generation side. The transmission networks as regulated assets, as long-term assets with long-term cash flows are very well suited to institutional investment. And clearly, if you look at Europe's infrastructure needs in terms of, for example, investment in renewables and building the related transmission network to facilitate that, institutional investors can, I believe, play an important role in that segment.
Great, thanks for that. And just one more final question. Does anyone have any thoughts on the potential for the use of project bonds in emerging markets when financing infrastructure?
Yeah, I guess I have a few thoughts. I mean, there are different currencies in different countries, pretty much stating the obvious, but many insurers and pension funds have liabilities they are really struggling to match. So if you go to Southeast Asia and talk to investors there, you'll find that they may have a Philippine peso or a Korean won mismatch and inability to source assets that can yield. and these same countries may, in certain circumstances, have very substantial financing needs for infrastructure. So there is every chance that the market will develop. There is also, though, all the same challenges we've seen historically. These are still markets where the legal frameworks, the regulatory bodies that govern are still clearly somewhat behind the Western European or North American space. So it will be that those need to be challenged first, and those need to be tested, but certainly there's appetite.
Great.
I think there's a unique consideration in relation to emerging markets, however, and that's the concept of sovereign risk. In relation to what is folded into the concept of sovereign risk, well, clearly you've got the institutional risk associated with due process of law and the regulatory framework, but also to the extent that transaction structures are involving sovereign or sub-sovereign entities in a contractual capacity, then clearly there is a direct relationship for any project between the credit standing of the sovereign itself, the host government that is, and where any particular mark in the sand may be drawn on the credit standing of an individual project.
Great, thanks, Andrew. And I think we've come to the end of the session now, and we've had a lot of questions from the audience, and unfortunately we're unable to cover all of them, but somebody from the IJ team will endeavour to get in touch with you and answer any questions that we can. I'd just like to ask all of the panellists if you wouldn't mind giving a couple of brief closing remarks. Andrew, if we could start with you.
Sure. I mean, it's been a pleasure to join this particular forum. In terms of observations, I think, as I mentioned, the interesting features of this market for me at the moment are the multiplicity of funding solutions, and I think over time there will be some degree of crystallization around precedents which have proven effective in the market, which will, I think, provide a very helpful focus to discrete funding models which are effective going forward.
Prashant.
Yeah, I guess what I'm most enthusiastic about is the dialogue has gone from a bank v bond model to a lot of banks now actually looking at alternative funding solutions and creating products for institutional investors and working with them, whether that be a bank bond model or banks clubbing with investors and forming a product which is suitable for their investor appetite.
Dominic.
I'm not sure I can add much to, because I'd agree with those comments. What I would say is just I find it a much healthier market than pre-crisis, although I work for a monoline, but the pre-crisis market was dominated by the monolines on the bonds and the banking market. Both those markets fell apart to a certain degree, which caused real stagnation in the market. So I think it will be a long time before we see a similar model developing. We're seeing all these different products, and there will be some losers as well as winners. But I think having that diversity is a healthy thing for all the stakeholders.
Okay. Alistair?
I think the only thing I'd like to add is just that the market is turning a corner. It's come from what's been at times a very low and frustrating base, and I just hope that now we see sponsors seeing that these are deliverable, trustworthy solutions and deliver great value for money, but also the authorities can now wholeheartedly start procuring and building out those pipelines a bit better, because the market is suffering from a lack of supply.
Cormac, did you have any final points to add?
Yeah, thank you very much. No, I think from the IB side, I would like to underline that, of course, we're happy to work with others, and the perspective, of course, is as a public bank looking to deliver value for money. In terms of the PBI initiative, the intention is to maximize the potential for institutional investment and to look for ways and means to do that. In terms of sectors covered, the European initiative doesn't cover all sectors. I alluded to that. It's the main transport networks, it's the main energy networks also in the telecommunications area. But in general, the perception that things are moving forward, yes, absolutely. And I think sharing the opinion with everybody else on the panel today, and clearly each transaction is helping move that forward. So I think there's a collective interest here in terms of the market and in terms of realizing on the potential for the institutional investor. Thank you very much.
Great. Well, I think this has been a very engaging debate, and I think it's a topic that could lend us to hours of discussion. Unfortunately, we don't have time for that today. So I'd like to thank my colleagues for what's been a really fascinating conversation. So thank you, Alistair, Cormac, Andrew, Prashant, and Dominic. And if you'd like to hear more on the Project Bond debate, you can join us at the 4th Annual World Infrastructure Summit in Amsterdam next month. For further details on that, please contact my colleague Rebecca Drake. Her details are on the screen. Thanks for listening.